Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. A victim out of the Emory University, Julian Emanuel, joins us right now. What was it like at Emory in Atlanta? Did you cut class and go out to Braves ball?
Well, we certainly went to the days when there were 5,000 people in the stands, and you could sit right down.
Jane Fonda.
You could sit right down next to Ted Turner and Jane Fonda.
Wonderful to have you here. You have the honor, you have the coolest equity job on the planet to hang with Ed Hyman every day at Evercore ISI. Is your shop and Ed linking into your work in equities? Are you sub 2% real GDP forward?
Well, look, so Ed has been on the inflation slowing more than anticipated for over a year.
Way out.
And he's on the economy is going to slow more than anticipated towards the end of the year and into 2025. And so, when you put that all together, the conclusion is pretty obvious with regard to what the trajectory
dampened
looks
economics, dampened nominal GDP. Why do stocks go up if the economy's slower?
So there are a lot of moving parts at this point. And the first is that there's lots and lots of liquidity out there. No surprise to anyone, whether it's corporate America throwing off, as you sort of referenced, huge amounts of free cash flow. Obviously, we know where that's centered, whether it's, households really flush with cash still. And frankly, there's this idea that the Fed will, not necessarily when and the degree to which they're going to cut, although we certainly heard this morning that the story get reiterated, but that they're actually going to do the right thing. So if inflation stays sticky for a number of more months, they'll be patient. If the economy starts to turn down, they will be less patient. Mistakes will not be made. Roll that all into the enthusiasm around AI and the potential for what we've seen as high multiple regimes can stay elevated. And you have a market that continues to rally.
Paul, Lisa did such a good job with that, data check, the Bloomberg Business Flash. Tesla 209, make it 210, is up $9, $219.
There you go. Okay, very good. Our good
I only
friends
did
Tesla.
That for Lisa.
Here's some nice round numbers for you, Tom. Mr. Emanuel here, he raised his year-end 24 S&P 500 price target to 6,000 from 4,750, and maybe saying 7,000 by year-end 2025. Those are numbers you can sink your teeth into. Mm-hmm. What's driving that, Ed?
So really what this was is some introspection on our parts, because it's very difficult to sort of set aside the valuation discipline, because when you look at the long sweep of history, buying low and, perhaps trimming high has been a pretty robust strategy to complement buy and hold. But what we found, and we have been proponents of AI underpinning the broader equity market for well over a year. I think we were pretty early to that party. We think it's still very early on in this theme, is that these high valuation regimes can persist, and valuation alone is not a reason to sell stocks. And when we look at the barbells, right, the probability of recession, the economy deteriorating, materially in the near term, we don't see it. And then the probability of a bubble inflating, we certainly don't see at this point. We're a long way from that.
How much of that's significant? I'm talking a 25% increase in your 24 price target. You don't see that on the street today. You see other banks raising it by 200, just slightly, 3 or 4 or 5%. How much of that was earnings? How much of that was expectation of Fed cutting? What was kind of the drivers there?
So it was really a mix of all of it, okay? And again, I go back to what I said earlier. Our confidence is whatever the right thing to do, the Fed is likely going to do the right thing, and that explains why we started the year at 6.5 cuts priced in and came down to here where basically we're at 1.5, and stocks have not faltered materially during that time.
Right.
We increased our earnings with the idea that even if a downturn hits later this year or early next, you still are in a robust cycle.
So to your people at Evercore ISI, sector by sector, you're the overall strategist in that. When you look at the big tech companies, is the risk a revenue shortfall? Is that really the sweat out there about the Magnificent Seven maintaining the excellence of 30 multiples?
Well, so you hit the nail on the head on this, Tom. If we'd been having this conversation 4 or 5 years ago, the idea that a large cap technology stock could persistently trade at 30 times would have been...
It was foolish. Why is it now not? This is critical.
Essentially because there's a view, and we share it, that the way the economy is developing, the way technology is developing, is that you're going to have revenue underpinnings. And the other part of that is, if you think about it, right, you go back to late 2022 when several of the Magnificent Seven basically disclosed that, yes, they could in fact cut costs because they were stockpiling labor. The fact is that corporate America has been getting ready for a recession that fortunately hasn't arrived yet for a year and a half, almost 2 years.
So, Julian, I mean, Tom and I are still trying to wrap our heads around AI. What is it? I guess we stop there. What is it? But anyway, how do we get exposure to it? Do we just buy NVIDIA? How are you talking to your clients about AI and maybe how to get exposure to it over time?
So what we think is important, because again, look, it's very difficult to buy stocks that have moved several 100% psychologically if you don't have a core position. We think you should have a core position in those kinds of stocks, but when you look at it, right, there's a number of companies that are proactively building competitive moats, both on the cost reduction side, which we all know that will be part of the story as jobs transform, but also importantly on the customer interaction, retention, loyalty side. And these types of companies are very upfront about talking about it in their quarterly earnings calls. And that's probably the most important thing that we as investors can do, is listen to what they say about AI on the earnings calls. Those are the companies that you want to be thinking about
long-term.
long-term.
What's so important here, Julian, and this goes back to the great work of Ed Yardeni, and I'm calling this bull market the Yardeni-Acampora bull market. Ed Hyman will know who both those people are. But the answer is, this goes back to the optimism to participate in the market, a la what C.J. Lawrence did years ago and what you do at Evercore and Evercore ISI is well. I want you to speak to people under the siren call. Barry Ritholtz has been on fire on this.
Yep.
The siren call of trying to time the market. Please, you and Ed, you gotta play if you want to win.
My 93-year-old father-in-law recently departed, lived a great life, basically was in stocks until the end, as much as in stocks as he could possibly, because he believed that when you look at it, and the data supports this, through economic cycles, through political turmoil, through geopolitics, wars, all of these things, that stocks are the long-term income-producing asset. And frankly, when you think about the things that we're trying to hedge, inflation, again, some of these uncertainties, the other fact is that if you look at it, the price chart of the S&P 500 mirrors the growth in earnings. And if you're going to get long-term earnings growth, which we do believe in fundamentally, you must be in stocks.
Well, can you, a year before, I would probably quit, but I mean, the surveillance casket, folks, is out back. Paul, can you see me doing this show?
Oh, yes.
At 91.
Yeah, I absolutely can. No question about it.
Jones Industrial Average.
Exactly. No problem there.
100,000.
So, Julian, all right, do I have to be... I mean, tech has led this market for 25 years. You have to be in tech, don't you?
You do.
You have to. I mean, it's almost like you throw out the valuation. I hate to say that, but how else do you play it?
So we talked about this earlier. There will come a time, that time is not now, when trimming a position in technology and communication services,
Yep.
which are the only two sectors outperforming the S&P 500 this year. And you would think that on balance, that would be a negative statement about the market. It is not, looking out on a 12-month basis.
We just got some hedge fund results, and they're like Citadel seems like they're getting it done, and there's others as well. And I mean, the Mets are playing better, so 0.72 must be doing okay. and the answer is, Julian, is these are fee-based, a point, 2 points, 2 and 20, whatever the math is. I'm looking at a blended fund skewed to high tech. I'm going to leave the name out of it, and their fee is 0.33%. Running billions of dollars. I mean, I'm sorry, the fees add up, don't they, to your equity return, particularly when dividends are reinvested.
They do. Look, Jack Bogle's entire career was built on that concept, Tom, founding Vanguard. And fees do add up. But what I would say about that is, again, there are times in our lives when diversifying away from stocks in a portfolio where stocks are the bedrock actually allows you to buy more stock into weakness. And frankly, a hedge fund that does well in all weathers of market, there are certainly a number of them out there. That's part of a prudently built portfolio as well. And there are a number of managers that have justified decades of that kind of fee structure.
What is your quantitative strategy team telling you?
So interestingly enough, and if you think about it, this is going to make sense. The last week, we've certainly seen, let's say politely, a good deal more political volatility. And when you think about how the second half of the year is likely to get underway, what we found is that the valuation factor, buying cheaper relatively stocks among sectors versus being underweight the more expensive stocks, actually hasn't worked. And that's not just a large cap tech concept. This is across all sectors. Our view is that when you think about in committing more capital to stocks right now, you're probably going to be more inclined to be more valuation sensitive, considering that there's more political risk out there than normal.
Julian, thank you so much. This has been great.
Pleasure.
Really, 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 really appreciate it. We need no translation on the debate and the fractious constructive debate at Morgan Stanley that, among others, Stephen Roach invented. It is a different house. Joining us now for this half hour, Jim Caron, CIO, Cross Asset Solutions, Senior Officer Argument at Morgan Stanley. What is the distinction? What is the number one point of debate at your shop?
I think what it is, and by the way, I think what it really is the question of when will the unemployment rate start to rise fast enough to give the Fed confidence in order to cut interest rates, right? Because where the debate is today is that there are various forms of inflation that are out there, right? You've got the super core, which is running too hot. You've got core CPI, which has made a lot of progress. You've got core PCE, which is kind of like in the sweet spot, and the Fed would go on that. But the question, though, is with those three data points somewhat conflicting, where does the Fed have confidence to actually go? Now, we think that maybe the Fed will cut interest rates. It'll start in September. But what's required for that to happen is for the unemployment rate to actually start to show some progress higher. And why that's important is because the declining trend in inflation, and it is declining, will be viewed by the Fed as sustainable and anchored decline in inflation if the unemployment rate rises, which would then put pressure downwards on wages. Wage inflation slowing should create a more stable inflation environment. So it's really a question about jobs creation, and it's a question about the path and pace at which inflation falls.
That's interesting because, again, I think most folks we talk to just say the Fed's focused on inflation, but really it's labor component of inflation which is key here. Is there a kind of a range, a number of inflation that you think the Fed will kick them into saying, okay, we've got some movement here? Is it 4.2%? Is it 4.5%?
Yeah, so that's the output, right? So that's like I would almost think of that as the residual,
okay,
right? I wouldn't really think of that as the absolute. I mean, yes, ultimately it will come down to that number, and it's the easiest way to understand it. But the Fed invented something called the super core for inflation, and this is core housing ex services. This is really a measure of inflation that's focused on more of the labor-intensive segments of the economy. So your barber, a janitor, somebody who's labor-intensive in terms. So basically, it's really a way of measuring inflation that is being contributed by wages. So, that number right now is still running pretty hot at 4.8%, but it is likely to decline. So I would say that to me is I would think of that as really the measure that the Fed's going to watch. If that starts to come down, the natural output of that, or the residual of that, will be that the unemployment rate should start to move up towards 4.2, 4.3. So, if I simplified it, yeah, I'd say that, around 4.3, 4.2, I think the Fed would feel comfortable.
In your cross-asset universe, does 60-40 work, or is there a 60-40 amendment to not so much enhance return, goose return, but to avoid challenges? What's the Caron 60-40?
Yeah, no, that's a great question, and it's going to be debated for a long time. But so it's not that the 60-40 doesn't work. It's just I think that the 60-40 will be suboptimal. And the reason why the 60-40 portfolio will be suboptimal is we have to take a little bit of a trip through history. If you go back to 1981 to 2021, if you look at that 40-year period of time, bonds did very well during that period. 37 out of 40 years they made money. So very stable, very good returns. Your Sharpe ratio, or your risk-adjusted return, if you had a 60-40 portfolio, was roughly 7%, which is great. Passive investing 60-40 did really well for that 40-year period of time. If you look from 2022, 23, and into 24, what you're seeing is that bonds are becoming less stable, less reliably, producing good, solid returns, and that's likely to occur into the future. So what it would suggest is that now the 60-40 might not give you passive, might not give you 7%, but it might actually only give you 5%. And that's a meaningful difference in types of returns. So I would say that the new way of thinking about how do we use bonds to hedge our portfolio needs to be a lot more flexible. So it could be 70-30, it could be 30-70 in some instances. Really what we're trying to account for is the volatility of returns in bonds, which we think will start to follow the business cycle more than just being a 40-year downward trend in rates and strong performance for that period of time. So we have to account for the variability in bonds going forward to make the adjustments in terms of the allocation 60-40. So it's not as simple as a passive.
Right.
I would say that. And you might even want to add alternative investments into the equation too.
Oh, you're killing me.
Well, I'm telling you, because what it does is it creates a diversification element that is attracting returns.
Jim Caron, Cross-Asset Solutions CIO, Morgan Stanley Investment Management. Hey, Jim, Lisa and Tom, they've both been in the Magnificent Seven stocks. They're just laughing all the way to the bank. I, unfortunately, have not. What do you tell equity investors to do is it okay just to be long these Magnificent Seven, or do we actually have to do some homework?
Well, look, the way I think about this is follow the money. The Magnificent Seven or the Magnificent 10 or whatever it is, they're doing well because their earnings and their earnings revisions have been exceptionally strong. If you look at the S&P 490, so if you X out those 7 or 10 stocks, if you look at the earnings revisions in that category, it's been pretty close to flat. It's been relatively dismal. So it's not that the broadening or the broader sectors of the market are these great opportunities that are just minting cash and earnings are going up. I think the market's rightfully so looking at it. So if you look at the equity market, the S&P 500, X the Magnificent Seven, it's up about 7% year to date, which is pretty good. I mean, that's not bad. If you look at the S&P 500 total with the Magnificent Seven in it, then it's up, closer to 15% year to date. So, it's really a question of following the money. So I would have to say that the way that I would look at this is that you still want to look at the cap-weighted S&P 500. You still want to incorporate that overweight to those, to those bigger stocks, because that's really what's capturing the earnings. That's what's driving the markets mostly right now. I think it's too early to say that we're going to have this cyclical recovery, that everything's going to start to move higher, and therefore you can broaden out to the other 490 with a lot of confidence. That's really not been the case for the last year plus, and I don't think that that's changing anytime soon, because a big, broad cyclical acceleration and recovery is not our base case.
How about valuation here? Have earnings kept up with this move we've seen off that, I guess, October 23 kind of level here?
Yeah, I mean, look, you mentioned NVIDIA earlier, in jest, but NVIDIA is a 30 PE stock. It's not like, is that high? Sure, it's high, but it's not it's not something that is astronomically high. A lot of the companies that are doing well are actually making money. So people make parallels back to the year 2000, 1999, the dot-com bubble. Back then, these companies weren't making money. Today, these big companies that are doing well are actually making a lot of money. Their earnings are there to justify it. So it's a big difference.
I want to talk here about free cash flow. I've been reading Michael Mauboussin. I've been going back to the Credit Suisse. He's now at Morgan Stanley. Do you guys talk? Caron and Mauboussin talking. Talk about nerd patrol.
I invest with him. So absolutely. He's one of the smartest people in the room. There's no question. So, look, I think some of the factors that we look at to think about how we become, let's say, defensive or smart about approaching this market, there's a couple factors. Size is going to matter, right? So the large cap companies are doing better than small. They just have better balance sheets. Good, strong balance sheets, free cash flow yield. So Mauboussin, would be all over that.
Right.
Earnings per share growth and interest rate coverage.
Okay.
So
I want to go Delta T on you. We're going to go aerospace engineer now.
Right.
And as you know, Jim, you can literally go log. You can throw a log on the x-axis here. I'm going to suggest that this era is where the terminal value is less important, and some form of weighting of quarter by quarter or year by year free cash flow excellence is getting us to these valuations. We've moved away from a classic 7-year DCF. Do you agree?
Yeah. So the way that I would phrase, I totally hear you. So the way that I would phrase that is that when you look at companies that don't have a lot of earnings, but you project a terminal value into the future and say, well, I can look past no earnings for a period of time because the terminal value is high, then that's, that error, I think, that's not where we are
But what
today.
about the Magnificent Seven? Microsoft, let's just pick it as, is Ballmer did pretty well. Did you see that? Ballmer's doing better than
But he hasn't sold a share.
Microsoft, to me, is not a 7-year, where are they going to be? It's a quarter-to-quarter slog of excellence.
Right. Well, it's turned into that. So I'd say that the terminal value for a lot of these, the Magnificent Seven, people debate as to how high it could actually possibly be, but it's a positive number, and it's a tangible positive number because they're making their earnings. The issue, though, is because their valuations, and I think this gets to your point, Tom, because their valuations are relatively high and there's high expectations, that they had better make their quarterly numbers. And if they don't, they're subject to a correction. And that's what makes the market relatively scary right now, is because you have such a narrow group of stocks that are really keeping up the index. If they miss a quarter, and if prices adjust in one of those stocks, it could have a meaningful impact on the overall index, and this could add to volatility in the markets.
By the way, probably the best notes we get from any guest is this guy.
He
really
studied
good.
Sears and Zemansky. If you got through Sears and Zemansky physics, you survived.
One thing jumps out at me, though, and I got to ask, French equities.
Yeah.
This will be the only time this week I think we talk about French equities.
Yeah.
What's going on there with the political unrest?
So, look, this is an outlier view in our portfolios, and when this political unrest took place, we saw this as a buying opportunity, primarily in the equity space. And the reason is I think that there was an overreaction in the markets to what happened in the French election. So, yes, the National Rally Party, Marine Le Pen's party, may take over the lower house of Congress and might have a majority state. And I respect that it creates some, disruption in the political norms within France. But the reaction we had in the market, if you look at the spreads between French bonds and bunds, that spread widening over a 1-week period rivaled the 2011-2012 period when the European Union was in question, in the first place. The equities fell to levels in terms of a standard deviation move you'd have to go back to 2017 to see some of these moves. So the extreme amount of move that took place over this, I just thought was just overdone. And if you look at French equities, year to date, they're about flat on the year. They were negative on the year. And if you look at the rest of the equity markets across Europe, they're up about 7-8%, US. This is so far being contained just to France. And I think that, and also to a narrow set of French companies. The broader French market, I still think is in good shape. And we saw this as an opportunity to buy good quality assets on the cheap.
All right. Jim Caron, this has been a joy. Joining us now, always tanned and rested from Brown University, Wendy Schiller. Her books are definitive, driving the Taubman Center at Brown forward. Wendy, I got to ask about the size of money in the donor culture within our modern politics. Did JFK or LBJ or frankly Clinton or Bush the younger bring in this kind of money that President Biden's bringing in?
Well, I mean, they didn't bring in the kind of money that we see today because they weren't legally allowed to, have that kind of money contributed. The rise of super PACs, as you know, and super PACs make it possible for wealthy people to contribute hundreds of millions of dollars. And that just didn't exist back then. But as you well know, Tom, because you know your history, there were other ways of coercing or gathering votes in those days that didn't require that much money. But in Rhode Island in the 1890s, Nelson Aldrich was a senator from Rhode Island. He was also the sort of de facto majority leader in the Senate, Republican. He handled all the business stuff and all the trade. He would have his lieutenants pay people $5 or $10, a lot of money in those days, to show up to vote.
There's $100 million out there. Somebody raised it over 3 cups of coffee, whatever. That's in a bank account, right? Whose money is that?
I mean, it really, really wealthy people contribute a ton of money. But the question is, really, in this election, I'm going into your field now. Is this really a good investment? Because voters know these two candidates really, really well. Money matters the most when one candidate is not as well known. You get a lot of bang for the buck from money and visibility. But here, what is the money buying, particularly in Donald Trump's case, because Republicans don't have the kind of infrastructure that the Democrats have to get out the vote. They have stronger enthusiasm and stronger loyalty, but they don't have the operational advantage on the ground. What are they paying for? That's my question. What do they need? What do they need the money for now?
If they don't spend this, Paul, where's the money in 5 years?
Oh, that's a great question.
A Christmas club account.
Yeah, exactly.
But they've also changed the rules, so it's a little dodgy. But state party committees, for example, can now receive money from federal party committees. They didn't used to, but Congress passed a law that lets them share that money. So it's much easier to meld the money than it used to be.
Wendy, what did you make of President Biden's commentary last night, his speech last night in reaction to the Trump immunity ruling?
It was much more coherent than his first 20 minutes of his debate performance, which was a good thing if you're President Biden's team. So the immunity decision, if you think about what the framers wrote about what they worried about the presidency, it actually hews pretty closely to that text. In other words, I think they probably did the best they could with this immunity decision. People may disagree with me, but if you look at what the founders worried about, this is what they were trying to parse out. Individual corruption versus sort of abuse of power. But the prospect of Donald Trump unfettered with complete immunity, and that's the way the media is sort of portraying this, I think it might shift some of those independents that fled perhaps on Thursday night back into considering, maybe we have to pick Biden, not Trump, because we are concerned about having Donald Trump in office with the perception in his mind of no holds barred, that he can do whatever he wants and he will go unpunished.
What's the status of the leadership in the Democratic Party today as it relates to President Biden and his viability?
Well, Paul, that would require identifying the leadership of the Democratic Party. And this has been the whole conundrum for the Democrats. The president of the United States is typically the leader of the party. So this is really, and Biden has not really delegated in that respect.
Okay.
You know, Chuck Schumer does his thing, Hakeem Jeffries does his thing. But really, there's not even a Nancy Pelosi. Whether you like her or you don't like her, she was a vocal leader in the party. You know, it's unclear to me whether it's Barack Obama, it's former President Bill Clinton, who can talk to Biden about whether he steps aside. But right now, as of last night, he did not look like anybody who was walking out the door.
So what should President Biden's strategy be going forward in this campaign?
Whatever he did to prepare for his remarks yesterday, do that every day. Make sure that when you are going before the public, you sound and look vibrant, but also Trump, and the issues that the Democrats are better on, particularly labor rights. You know, they have not talked enough about what a Republican trifecta will do to labor rights. And I think these are the key voters in the swing states, at least the upper Midwest and Nevada, for President Biden's campaign race.
Professor Schiller of Providence, Rhode Island, explain to our national audience and our global audience who the former governor of Rhode Island is. Some percolate. Henrietta Trace mentioned this the other day. Gina Raimondo on the list out there. Who is she?
Gina Raimondo is a practical politician. She is business friendly. And she really solves things problem by problem. She does, I know people might get upset, remind me a little bit of President Obama. You know, she is not wedded to a particular ideology. She takes things as they come and tries to plan ahead and really takes stands, right? So that's the way she thinks. That's great for governing. Is it great for inspiring voters? That's a question mark in a presidential campaign.
Can she appeal to the left of the Democratic Party? Can she check the boxes that President Biden has to check every day?
Her record, you know, public unions in Rhode Island still don't like her because of union pension reform, but on things like women's freedom of choice, abortion, gun control, education, she has a very strong record as governor of Rhode Island. So, you know, it depends what she pitches. But if you ask me to choose between Gina Raimondo and Gretchen Whitmer, that's not a contest, right? Gretchen Whitmer can win Michigan. She seems reluctant to get into the fray, but she can bring a swing state. That's something Gina Raimondo has yet to prove. So if you're going to switch gears now, you know, I don't see where you pick Gina over Gretchen Whitmer.
Hugely valuable. Yep. Professor Schiller, thank you. Lisa, what do you have?
All right, this is what we talked about before. You mentioned it, Paul. Barry Diller is back. Yes, he led Paramount Pictures. Decades ago, he lost the bidding war for the company. Now he's considering making an offer for control of its parent company. Now, this is what the New York Times is reporting. Sources telling them that Diller of digital media company IAC, he signed a non-disclosure agreement with National Amusements. But you know, Paramount, IAC, National Amusements, they have not commented on this, but this is the word that is going out. I mean, Paramount's been weighing its options for months. You know that.
Yeah, I mean, Barry Diller, he's done everything there is to do in media, including creating a little television network called the Fox Network, thanks to Bart Simpson. But that was the 80s. That was the 90s. Again, in my opinion, as much as I admire Barry Diller, he is not a credible bidder. There has not been one credible bidder for Paramount this entire process. And that's shocking and sad, but it just reflects kind of where we are in this evolution of the media business.
It's a general statement. Do you or experts like Rick Greenfield, Craig Moffett, Michael Nathanson, do they assume somebody's going to buy this and break it up?
You know, I'm not sure. I think a lot of people, the real value here of Paramount is in the studio. I mean, the Paramount film and television studio is one of just 3 or 4 of that scale in the business. So that has value. How much value, I don't know, and how much value to put on the library. The cable networks that are part of Viacom, think about, you know, MTV, Country Music Television, TNN, all those things. The value is declining every single day as cord cutting continues. So it's real tough to value this asset.
I saw Warner Brothers Discovery having a challenge to it yesterday afternoon. Next, Lisa.
All right, we go from Paramount to Imagine Entertainment. That's Ron Howard, Brian Grazer's company. They're looking for a buyer. This is according to the Wall Street Journal. They're working with an investment bank after receiving some interest, but a deal that could allow Imagine's main financial backer, who is Rain Group, to kind of exit. But there's been a lot going on. Hollywood studio streamers, they're pulling back on the number of projects they take on. There was this big boom in spending. So valuations for independent production companies, well, they're starting to fall over the years. But it's not the first time they explored a sale. If in 2022, Imagine talked about selling a more than 70% stake in the company to a London-based investment firm for about $600 million to $800 million. So that kind of puts a price range out there. But this possibly could happen.
Yeah, I mean, they have a huge quality library here. But, they're kind of probably coming to the end of their high output years if you talk to Ron Howard and Brian Grazer. So let's, like a musician, Tom, would sell their catalog. And we're seeing a lot of that these days. This is a little bit along those lines here. And somebody will buy it.
Oh, that's a good comparison.
Yeah.
Okay.
Yeah.
No. But they have a few things. I mean, they have a series for Netflix coming out.
Opie will do well.
That's
right.
Yeah, Opie will do well.
There we go.
Next.
We've heard of shrinkflation. We've talked about that. But now more retailers using upflation to get Americans to buy. Okay, upflation is when you find a new use for an old product and then you charge more for it. Yeah. Okay, so this is being used. This is a great big take article. You have to take a look at it on the terminal. Here's an example. Procter & Gamble, they're charging $14 for this all-over body deodorant, which is double the cost of a standard stick. So they're saying people are falling for it. Yes. The problem, they're getting tired of shrinkflation, right? So they started doing different things. You went to cheaper alternatives. You started to buy fewer essential items. But now Procter & Gamble actually found that revenue growth came from people buying fewer things at higher prices. So they're willing to pay more if they buy less of a few other things.
It used to be easy. The rich kids in the neighborhood, they had Irish Spring.
Right.
And the rest of us had, I can't remember what bilge it was.
We'll go with Dove soap.
They have Irish Spring, 3 houses away.
Yeah,
we don't
exactly.
You could smell it 3 houses away.
Next.
You could. That's a tough smell. Okay, at the same time, fast food chains, we've been talking about this. They've been lowering prices to attract customers. So now we have another entry into the value meal wars. It is Sonic. Yes, Sonic says that unlike McDonald's, Burger King, Taco Bell, who are doing these temporary value meals, Sonic is saying their meal value is here to stay for good, okay? They're calling it a fun 99 menu, so you have burgers, snacks, desserts, new Crunch Wraps. They are $1.99
This is for Tom, Lisa. Okay. The $1.99 menu will also introduce 2 new items, a Bacon Ranch Queso Wrap and a Southwest Crunch Queso Wrap.
Yeah, I see that
Tom.
here.
He's going to pull up in the Bentley, out in the Hamptons, and
like they have tots for $1.99. How many tots do you get?
It doesn't say which size it is. You can get a shake too. They have those 12 different flavors of shakes.
Yeah, like how big is it for $1.99?
I think the shake is either the 12 or the 16 ounce.
I've not been to a Sonic.
I went when they first started opening, but I haven't been. I mean, it's nice. They come out to
you drive
your car.
Through. You drive up, right?
No, you pull in, and the people come out to your car. They used to do it on roller skates. I don't know if they still do anymore. Do they still do the roller skates?
Yeah, I had a job there. Can you see me on roller skates?
It's been a while.
Can you see me on roller skates?
The servers come on the roller skates.
Anything else?
No, but that's it.
You mentioned butter.
Yes.
I mean, butter's up.
It's up. They're saying because they're focused more on cheese, and that's taking away.
They have to decide what to
butter.
do with their milk.
We need more cows, is what we need.
Yeah,
cheese.
And the problem is that it's coming at the same time that holiday season, baking season, starting to I don't want to talk holiday in the summer, but it's coming up. It's coming up.
Lisa Mateo, thank you so much. The newspapers today. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.